Good morning, hello and welcome to Opening Bell. Thank you for joining us here on Moneycontrol, and we're here with the latest market action and coverage. It's Tuesday. I'm Surabhi Upadhyay, and actually we don't have too many global markets trading. A holiday on Wall Street overnight, and most of the Asian markets shut for the Chinese Lunar New Year break as well. So global cues are thin, but locally, yesterday's trading action inspired confidence because the bulls managed to resurface. They managed to fight back and reclaim some important levels on the Nifty as well. So the question really is the worst of this IT-related sell-off over? Will we see more value buying emerge? Will IT stop torpedoing the bulls' case? That's really what we are looking at. Let's get started. Lots to cover, but here are the headlines first up. Wall Street futures mildly higher following a holiday on Monday in observance of President's Day. Asian markets trade cautious in a holiday-thinned trade as majority of the markets remain closed on account of Lunar New Year. Meanwhile, the GIFT Nifty is indicating a lower start for Indian equities. Brent crude prices hover around $68 per barrel as investors closely watch a second round of US-Iran talks. Meanwhile, gold fell to around $4,949 per ounce as investors take profits after prices rose in the previous session, driven by weaker than expected US CPI data. India's trade deficit widens to a three-month high of more than $34 billion in January, led by a surge in gold and silver imports. Gold imports particularly surged almost 4.5 times to $12 billion in January as India's penchant for gold ETFs has an unexpected impact. Indian trade negotiators will visit the United States next week to finalize the agreement for the first tranche of a trade deal. Under the deal, the team will pursue reduction of tariffs on all Indian exports to 18%, while White House will withdraw the 25% additional punitive tariff. The five-day AI Impact Summit opened in New Delhi with Prime Minister Modi inaugurating the event yesterday. Anthropic CEO says India is the second largest market for the company's chatbot Claude, and business run rate has doubled in the last 4 months. The AI giant expands India footprint with an office in Bengaluru. All right, so those are the big headlines, and many of those headlines come in from the tech space. And of course, we know that tech has been the center stage. I mean, that's where the problem has been in the last couple of sessions of the market. But yesterday, there was a recovery in the overall market, including in tech stocks. And we'll talk more about that as we go forward. By the way, today is the all-important Infosys Investor Day. So that's something to keep a track on as well. Now, as we've told you in the headlines, we don't have too many global cues. US markets were shut on account of the President's Day holiday. And all of Asia, practically every single big Asian market, South Korea, Singapore, China, Hong Kong, all of those markets shut for the Chinese New Year, for the Lunar New Year holiday. By the way, watch out for headlines coming out of Geneva. Important meetings taking place in Geneva. There is, of course, the US-Iran negotiations, where they're discussing a whole range of issues, including, Iran's nuclear arsenal, what happens with trade, so on and so forth. And also the Russia-Ukraine meeting, the next round of peace talks, that is to be held in Geneva as well today. So some of these geopolitical conversations will be extremely important to track. We will have Fed minutes come out tomorrow. So this is just in terms of what's up on the economic calendar later this week. Fed minutes come in tomorrow. And remember, the CPI inflation in the US on Friday was soft. The expectation is that will allow the Fed to go ahead with more rate cuts. Let's see what the minutes from the previous meeting, indicated. Then you have another important inflation reading coming out on Friday in the US, which is the Core PCE. And that comes out on Friday. It's also something that the Fed tracks carefully as it sets monetary policy. Now, for us, good news coming in yesterday. Almost a 1% recovery on the indices. The broader market did well as well. Mid-caps had a good comeback. And in all of this, the Nifty has managed to reclaim the 25,650 level. In fact, it's now heading, towards the close. It was almost heading towards 25,700 once again. It's managed to reclaim its space above the 20 DMA as well as the 100 DMA. So some, moving averages for reference. Yesterday, FIIs were still sellers. That's the bit of a dampener from yesterday's trading action. They sold off cash stocks worth about 970 odd crore rupees. Domestic institutions were buyers as usual, and they bought stocks worth just under 1,670 crore rupees. So that's the fund flow situation. And like I'm saying, that it's really going to be all eyes on that Infosys Investor Day. Also on the AI summit, really, because investors want to get more clues into how disruptive is this AI for Indian companies, the listed Indian ecosystem of IT services companies. What happens? Is it going to be one of those disruptions where the companies ultimately come out on top, or is it going to be different this time? So we'll have both Mr. Nandan Lelikani as well as Mr. Salil Parekh address investors. So that's an important event to watch out. So we'll discuss all of this. We'll get to some of the stocks in action as well. But let me now welcome our guests on the show. We have Aishwarya Dadich, founder and CIO of Findent Asset Management, joining in. Aishwarya, good morning. Thank you so much for being with us. Great to have you in. So, Aishwarya, what have you made of the market action? All of these IT headlines, which bears made the most of it. But yesterday, we had some semblance of stability. Do you think the worst is over?
Good morning to all the viewers. Obviously, I believe we have entered a lull market after the quarterly season. Not much of information hitting the market, and as you said, majority of the global markets are shut. But back tomorrow, yesterday, what we witnessed was some revival in IT. I sincerely believe that IT is still not out of the woods. The sentiment adversely will impact the fear about growth taking a hit because of the impact on their ADM and the ERP implementations and things like that because of Anthropic and all that is always there. But if you ask me clearly whether majority of these Indian IT companies will stay put with growth over the next 5 years, yes. Whether the software companies will exist even after 10 years, the answer is yes. And over the last 20 years of at least my career, I have seen many such events where every technology is being told that it's completely different and it will, hit the business big way, whether it was cloud or SMAC or digital and whatnot. But we always seen that, Indian IT companies have found ways and means to, get that revenue going and ticking. Obviously, this is one where the impact is both on revenue as well as an employee. But I believe Indian IT would be required to, basically modernize the whole legacy system which is in place. And we believe that if I look at on fundamentals, if I just see what kind of growth rate at this valuation majority of these IT companies are building in, on the free cash flow yield generation capabilities, they are at these prices at 15 to 18 time PE, are basically building 6 to 7% free cash flow yield. And if we compare it to various of other events, the numbers were much higher, from 12 to 15 to 20% FCFC imbibing into those numbers. And we should not forget, so if you remember COVID and after COVID in 21 mid, IT index was almost 16% of our Nifty 50 allocation. Today, I think we're at decadal low at around close to 8.5%. So pessimism is all around. And the fear is obviously that the revenue will be hit hard. Somehow at Fident, we don't believe that. We believe that obviously there will be some, sentiment which will prevail. In short, we believe it's a time to go and do shopping in IT. Possibly a couple of months or quarters, there will be uncertainty or the stock price may stay here or possibly go down further by 5-10%. But there is more to gain than to lose. So we are very positive on our capabilities of Indian IT to find ways to move out of it. And I believe at these valuations, risk reward is very favorable.
Okay, so you are a supporter of IT, given the sell-off. I mean, everything's good at a price, right? Just to figure out whether you've reached that price point or not. So Aishwarya feels that there's some merit in looking at IT stocks. Okay, Aishwarya, hold that thought. We'll talk about it a lot more. Let me also welcome in Shrikant Chauhan into the conversation. Shrikant, great to have you with us. Join on this format, and I'm glad to connect on Moneycontrol. So Shrikant, tell us, are you bringing us good news this morning? Is the worst of the bear phase over? Yesterday, finally, we had some green on the screen. It looks so good. So what did you make of it?
Yeah, good morning, Survi. Good morning, everyone. And many congratulations for this new opportunity. And you did really well since last almost, I can say, at least 20-25 years. And definitely you will do much better in your new role. So
really, Shrikant, looking forward to actually working with you and the entire team at Kotak Securities as well. Because our idea is to make markets as simple as possible for investors out there. People have very short attention spans, so we have a tougher job at hand to deliver that piece of information to them in nice, short, simple to understand nuggets. So I look forward to working with you as we get on this journey. Thank you so much. Go on. You were talking about the
My
market.
entire team will definitely will support you and your entire team.
Thank you. Thank you
For
so much.
markets,
Thank
yes,
you.
we have seen, I think after last 2-3 months of instability in the market, now the flows are turning more and more stable. If we go through with the domestic flows, then based on quarterly numbers and based on the overall trade deal news flow, now the currency has also started stabilizing. Quarterly numbers are better than the expectations. And I think this particular news flow is definitely going to support the market on the downside whenever there is a correction in the market. From the global markets, if we see, then bond yield was around 4.40, 4.20 for last so many months. But now it is very close to the crucial level of 4%. And in case if it breaks 4%, then we can expect furthermore weakness, furthermore gradual downward activity in the 10-year bond yield of US. So, which is something positive for emerging markets. That is what I am to say. And dollar index, which was around 97, 90, 98, 99 levels, it's currently trading below the mark of 97. So I think all these macros are definitely going to support the market on the downside. And I am of the view that downside is, let's say, we can see again 25,500, 400 in the near term. But on the higher side, the market is definitely going to rally in next few months. So eventually we are expecting market to move towards 27,000. And by the end of calendar year, we are of the view that index should be somewhere close to 29,000. But in the near term, because of this uncertain news flow, we may see some more volatility, and that will be an opportunity for investors as well as traders to take some positional trades.
So, Shrikant, now just expand on that. Those positional trades, should they be all on the upside? I mean, is this still a buy on dips market at a fundamental level?
Yeah, definitely. Because see, if we consider the overall performance of the market, then it has spent a lot of time within the range of 26,300 and 25,000, 24,500 on the downside. So within these 2,000 points, the market is consolidating. And on the dismissal of 26,400, we can expect rally towards the next levels. But till then, all these large cap companies like HDFC Bank, Reliance, ICICI Bank, they all are consolidating at we can say similar sort of levels. And around those important levels, whenever they are falling, whenever they are correcting from the highs, we are seeing good amount of buying interest. So broadly, I am of the view that it's a definitely buy on dips market, and we should be buyer at current levels and more on dips.
Does that include IT stocks, Shrikant? So buy the dip theory, does it apply there?
Yeah, it's a we can say it's $1 billion question. Because the way they have fallen in last 10 days after the announcement of the trade deal, I am of the view that someone has taken exit call from the IT stocks or IT sector, and they have just battered the sector. The IT index was around 40,000 levels. From there, all the way it fell to 30,000 in a very short span of time.
True.
So whenever we see such type of activity in the market, we need to be careful. Ideal strategy should be to look for reducing exposure if there is any upward activity or bounce back after hitting the extreme lows. So for the time being, it is better to stay away from taking any contra call. Let the things get stabilized. Then only we can enter into the market for IT stocks.
Okay. Okay. All right. Aishwarya, you've already made your point clear that you think that IT is looking, pretty decent to consider from an investment perspective at this juncture. I want to talk about some other spaces as well. I mean, financials in particular. What have you made of the gold financiers? Because that move on Muthoot, we all still remember that big crack, 10-11%, despite numbers being pretty okay. Manappuram is going through its own corporate action. I mean, Bain will come over as a promoter of the company. So within the non-bank space, let's start with non-banks first. Would you look at these gold financiers? Would you look at something else? Shriram Finance as well has picked up big money, and they've already got the RBI approvals for the Japanese investors to come in. So again, from the non-bank financial space, what would you keep your eye on and what do you like?
Yeah, so Surbi, we are very positive in that space. Given the way how credit growth has picked up, if you see the latest data, even in this quarter, majority of them have. So if I see the blended number, the growth is upward of 13%. We saw credit growth inching to almost 14.5% end of March, end of January 31st. So we are very positive, and how are we playing through is like we are invested into Shriram Finance in the last 1.5, 2 years. That is one of the investment which has really worked well for us. And what has really given us confidence is the way we have seen majority of the FDI happening in the space, right from Federal to RBL, Manappuram, Shriram, and many others. It gives that there is a comfort on the valuation and the kind of growth which is visible. And second point is that if you really look at the stack, compare it to the private players, and look at how this NBFCs and other non-banking player has played out across parameters, whether it is name, asset quality, look at to cost to average assets, and their ability to generate return ratios, ROE and ROA. There's a remarkable improvement over the last 3, 4 years, but there was a gap on the valuation compared to what the other listed large players were trading at. That valuation gap has inched up. So even in Chiram, we have seen massive re-rating of Cholamandalam right from 2020 till 2023. But that part played out in Shriram, and that's why we went ahead and invested into Shriram Finance there. Coming to gold, we were very positive on the gold assets space, but there are very few handful of players you can play through. Obviously, Manappuram is one which we have seen that stock from almost 160, 170 has moved to upward of 300. And because of Bain coming through, I believe there's a lot of improvement which will happen, and that will give a lot of comfort to the investors. And there's obviously a open offer which is just around the corner. And we believe even that gold prices at this level, if they sustain, that provide a lot of impetus for at least the growth. Even Muthoot came out with a very strong guidance on tonnage, but possibly there's some sort of market loss which is happening for Muthoot, which has been taken over by other non-gold financiers. But having said that, I believe there's one area which one should be aware of, that kind of volatility in the gold price that will have a clear-cut impact on how many of these gold NBFCs will play out. So I would say easy money making is more or less behind both from Manappuram and Muthoot. It will be more calibrated approach for any investors to go and invest. We at Fidenta staying away from both of these gold finances. We are positive more on NBFCs and your say SMITs, primarily the smaller banks, and some large allocation to the private banks over there. We are staying away from PSBs, but we are very, very positive on that space. Only one area in the NBFC which I'm a bit doubtful about growth is affordable housing. We have seen the last 2, 3 quarters the growth is sluggishing. The growth is not happening in the low segment, and we will be watchful of a couple of more quarters to take a call whether to get into or not. But that is one area which is somewhat not interesting, but majority of the other ones are making a comeback.
Okay, all right. We'll talk more about some of these financial stocks as we go along. By the way, someone on our live YouTube stream is asking the question, "Aaj Nifty mein kya ho sakta hai?" We'll get to that. We'll get Shrikant to answer more specific here and now Nifty trades in just a bit. Ravi's asking me about, okay, why did I move out of Bazaar call? It was a fab troika. Ravi, thank you so much. But yes, I mean, here on Moneycontrol, so not too far away, and we continue to have market conversations. So that's what's important. Shrikant, before we get to stocks and news, since some of our viewers are already asking that question, I mean, the here and now, immediate here and now for the Nifty, what levels to go with? At what level do you enter? How long can that trade run? Where should stop losses come in? What would the Nifty trade be?
Yeah, so if we go through with the averages and option statistics, then based on that, the market is having support at 25,500. Below that, again, the market can fall back to the yesterday's lowest level, which was around 25,370, 350. So ideal strategy should be to look for taking some contra bet of going long if there is any lower opening today, up to 25,600, with a tight stop loss at 25,400 of 25,500 on the downside. If it breaks 25,500, then we have to exit because it's a intraday trade that we are suggesting for our clients.
Sure.
But yes, in case if there is any consistent weakness in the market and if the market remains below 25,500, then we can expect further more weakness. Otherwise, I am of the view that
And
25,500 should act as major support.
this, I mean, since it's an intraday trade, you would expect it to run to what kind of target? Nifty on the upside, Shrikant?
Then again, on the higher side, 25,750, 25,800 going to act as major resistance. Because yesterday, when there was like
Okay.
upward activity in the market, we saw resistance shifting from 26,000 to 25,800. So 25,800 is now the next level to watch out for.
Okay, got that, got that. All right. Let's do one thing, gentlemen. Let's quickly run through some of the stocks and news today. Earnings season is thankfully over, so it's more peaceful this morning, but we have a couple of stocks that should be on your radar, so let's quickly go through them. First and foremost among them obviously has to be Infosys. Like we've been telling you, the company is planning to outline its AI strategy at its investor day today. CEO Salil Parekh is going to be addressing investors and talking about how AI will translate more into growth. Mr. Nandan Lilikani is also speaking at that event. It starts at 11 o'clock, so big one to watch out for. This JSW Infra, the board is meeting on the 20th of February to consider a fundraise. This is going to be by a mix of equity instruments, so watch out for this. Cochin Shipyard has emerged as the lowest bidder for a 5,000 crore rupee Navy vessel contract. So Cochin Shipyard on the radar because of this. The final award is, of course, subject to the completion of all the formalities. So we need to sort of wait for the final green signal to come through. Texmaco Rail, it has secured a small order, not too big, but about 219 crores. This is from Mumbai Railways for the design, supply and installation of the suburban rail line network. Embassy Developments, it's received RERA approval for its first project in Alibag near Mumbai. The estimated GDV, the gross development value of this project, is about 400 crores. So that's Embassy in focus as well. Moving on, BLS E-Services, the company is looking to acquire 100% stake in Atiati Tech. This is an all-cash deal. So BLS E-Services basically done a small acquisition. The value of this is about 154 crore rupees. They're looking to complete it by the 31st of March. So these are some of the stocks and news. Like I said, not too many names. Shrikant, I just want to go back to that point on technology. Let's go there and put some numbers to this. Now, if someone is looking to take a short-term trade on IT stocks, I'm not even talking about investment. Actually, tell us if you think it deserves a more, a longer-term positional place in portfolios at all. But even if someone wants a short trade, 1-2 day trade, between the entire IT pack, which stocks would you call out? Because everything was thrashed, right? Mid cap, large cap, everything was down. So where do you see the trades now?
So from the IT services or IT particular sector, these large cap stocks have fallen to their extreme levels in last 3-4 days. And stock like Infosys, TCS, they have fallen to their extreme levels. But if we consider the relative strength of all these stocks, then in that Tech Mahindra is much better candidate to buy for, because it has fallen after hitting new highs and it is now very close to its crucial level, but it is still much, much better as compared to other stocks in terms of their previous lows. So at current levels, Tech Mahindra looks much better candidate to take some long bet with a view of bounce back or short-term trade. We can again expect on the higher side 1625 or 1650 sort of levels. And yesterday, day before yesterday's levels, and I mean to say the lows of Friday, they are going to act as major trend deciding levels. So those levels should be the final stop loss for creating any long positions. For Tech Mahindra, that level was 1465. So 1465 should be the final stop loss for buying Tech Mahindra at current levels. Along with Tech Mahindra, I would like to go with Coforge, because there also we saw huge hammering. But since last 2 days, the stock is stabilizing above the level of 1330, 1335. So we can say that the stock has made a meaningful bottom at 1330. That should be the final stop loss. Currently, it is around 1390 and it's a high beta stock. So whenever there is a upward activity or some rebound in the market, we saw this stock moving back to its important resistance level. And the resistance level is around 1550. So at this level, Coforge and Tech Mahindra should be the candidate to buy for.
Okay, so there you go, viewers. You've got two trading ideas from the IT pack for today, Coforge and Tech Mahindra. Got that. Aishwarya, I want to talk defense stocks with you. I mean, Cochin Shipyard obviously is specifically in focus today because of this Navy contract that they're going for. What do you think of Cochin? Overall, the defense index is 12% off the peak. The stocks really got hammered after the budget, right? Would you venture in with any fresh buys at this point?
Yeah, so I believe obviously defense has been off the investor radar lately, but if I see the medium term and long term view, I believe defense story is very much in shape. With the way geopolitical situation is going globally as well as along with our neighbors, I believe the intensity of spending by government is there. And if you look at the way the order book has panned out for majority of this player, I believe that continuity of the revenue growth will be very sacrosanct going ahead. At present, what I will plan through is more investing through larger defense players in the name of BEL or HAL. BEL is possibly one of the best performing stock of last 1 year. HAL has seen some issues lately because of them not being qualified for certain large orders, but I believe that part is not going to really impact them, and that will be more the performance of the stock will be more dependent on how they turn around with their ability to get G engines and deliver on that front. But apart from that, two names I believe going down, whether it is Cochin or possibly other names, the valuation is a parameter which is getting us a bit of uncomfortable zone given the way that the growth is there. So we will be buyer into those names if the valuation comes more in favor of risk reward. Currently, I think we will be staying away from majority of the mid-size defense name and small size defense name, including players like Cochin and others. But I believe if you have a long-term outlook of 3 to 5 years, then this valuation can be justified. But we are more of a value picker, and that's why we are staying away from these kind of players. And that advice I will give for investors that you should be see valuation in conjunction with growth to really make out something meaningful from the defense story going ahead.
Okay, all right, got that. By the way, speaking of defense, we should keep our eye on TVS Supply Chain as well. That's another stock in news today. TVS Supply Chain has partnered with an Italian company, an Italian group today. And it's a partnership to look at interests in the aerospace arena in defense. So it seems the TVS group is also looking at defense as a big opportunity, and that stock's already reacting in the pre-open. Before I come to both our guests and we take our compounding idea of the day and the final trades for the day, let's look at the pre-open session which has kicked off. It's a little quiet, like the GIFT Nifty was indicating. There's a bit of a cautious start that we're getting. That's TVS Supply Chain on the screen, the stock that we were just discussing. The Nifty is down about 32 to 33 points at the pre-open session right now. Metal stocks are looking a little weak. Hindalco is down 1.5. JSW Steel is losing some ground as well. And then you have some of the larger banks, SBI, ICICI Bank. They're all a little quiet in the pre-open session. We should get some of those pre-open rates up. That's how it's playing out. Reliance is also down by about 0.5%, and that explains why the pre-open session is off to a bit of a quiet start. Okay, Shrikant, so coming to your trading advice for the day. So those are the stocks. We've got the stocks on the screen. Some of the gainers you can see are actually on the IT side, and both our guests have pointed out that IT does offer opportunities right now. It's just you need to decide your time horizon and what you're going with. And Shrikant has already called out Tech Mahindra and Coforge as his two IT trades. So those pre-open rates will keep playing on the screen. Beyond the IT names, Shrikant, what else would you go with, your trades for today?
So I think if we go through with the momentum and trend in the market, then we need to focus on metals, and there specifically steel stocks are doing much better. Whenever there is a correction in the market and recovery, we see first buying interest in stocks like Tata Steel, Jindal Steel and Power, JSW Steel, and there most of the stock have crossed their all-time highs. So which is something really significant. And this market is particularly the market of trend followers market. So I am of the view that we should look for adding stocks like JSW Steel, Jindal Steel and Power at current levels. And if there is a lower opening, then it will be an opportunity for traders to take some long bets, especially for Jindal Steel and Power. Currently, it is around, we can say, around 1210. In case if there is any lower opening, then also it's a buy. But it's a buy with a final stop loss at 1180. Again, we can expect 1250, 1275 sort of levels in next 1 or 2 days of time. So it's a positional trade. We like JSW Steel. There also we have a target of close to 1300. We can look for adding this stock at current levels with a stop loss close to 1230 on the downside. And after um, uh, metal space, if we have to focus on any particular sector, then I think private banks have now very close to their important support levels. HDFC Bank especially, which was around 1000 levels, fell to 900, and yesterday we saw decent pullback. So at 925, it's a buy with a stop loss at 905, and again we can expect 950, 960 sort of levels. So ICICI Bank, HDFC Bank, I think these are the stocks to buy for even at current levels.
Okay, all right, got that. Thanks very much, Shrikant. Great to have you on the show this morning. Thank you for joining in and giving a lot of context to our viewers. And we hope this is, the first of many, many interactions. Look forward to remaining in touch with you and your team. You have a great day. Thank you.
Thank you, Somi.
All right, Shrikant. Thanks very much for that. Aishwarya, before we move on, capital market stocks, yesterday's big story. The way BSE sold off, the way, there was weakness in Grow. Angel One was a major casualty yesterday. Now, we know the news that RBI has tightened this financing, bank financing for this segment. But how bad is it? And what's your approach going to be?
So, if we really connect the dots, will be, it all started with budget, right? When FM came and said that, okay, let's increase the STT. And then we saw that the possible impact on F&O volumes. And then RBI came out with, obviously, we all aware about bank guarantees and the requirement of higher funding. Possibly, it will impact the HFT, the high frequency trading, which is a large part of the F&O segment. And I would not be surprised if regulator came out with more restriction on to curb the speculation part of FNO. So that intent of the government is very clear that they want to clean that speculation part, especially done by the retail participation. And I believe we have seen that happening with first initially with online gaming, and then we possibly saw into other segment, and then possibly coming into this FNO. And that is what is creating pressure on both the brokerage houses as well as the exchange. Now, having said that, we are mentally ready for more restrictions coming over the next couple of months or so. But we believe that the ability to maneuver this with the exchanges is pretty high. All this will bring more stickiness to the I would say the growth numbers. They might be a blip for a couple of months and so, but market will find its ways and means. So obviously, the most of the street is expecting there will be 10 to 15% kind of a negative impact on the F&O volumes on account of these initiatives of the exchanges. But we believe that this is slightly overestimated. The impact will be there, but I think it will be in the range of low single digit on F&O volumes, primarily because of HFT, because once your cost goes up, the arbitrage and their IR gets a direct hit, and their ability to maintain that alpha goes down. So that could be an area which will get this volume decline. But if you ask me, at Fidel, we are very positive on exchange. We are taking it from 2 to 3 years view. We are very positive on players like BSE. We also like NSE being the IPO is around the corner. And we believe that the growth all of these companies are pretty strong, and this will be, if you see the last 2 years, we have seen enough of this kind of event, and then we have seen the reversal also happening anytime soon because of any smaller changes here and there. So we remain positive as long as the growth and the internal stack is very strong, and we believe they have that whereabouts to manage and maneuver through this uncertainty. So in short term, there will be volatility, but at least if you have a 6 month or a year view, we are very positive still beyond that.
Okay. All right, Aishwarya, thank you so much for joining in today and giving us your view on all the stocks that we have discussed and covered. You have a good day, and we'll connect again soon. Thanks for joining in. Well, we just have about 5 minutes to go. Thank you. 5 minutes to go before we kickstart today's trading action. and what else is center stage, top of mind, but IT. So let's go across someone who's been studying this sector and the companies in great detail. Ashutosh Sharma, head of Forrester Research here in India, is now joining in. Ashutosh, thank you so much for being with us, and welcome to Moneycontrol. Thanks for joining us on our live stream coverage. So Ashutosh, this is not just an India thing, right? I mean, over the last 1.5 weeks, enough questions have been raised on whether AI is going to destroy the global IT services model, the SaaS model. And then those concerns obviously percolated down to India as well. So let's start right there. Where do you think the truth lies?
Good morning, Survi. Good morning to you and all your viewers. Thank you for inviting me, and it's my pleasure to be here. We certainly are living in interesting times, aren't we? So when it comes to tech, what exactly triggered this was probably the fact that people were already on the edge. They were always looking for some reason to figure out whether their bets that they have made on tech, are they okay or not, and they didn't want to be the last one to get off the boat, right? So I think that's a bit of what's at play here. So truth, it's certainly not as bleak as I believe people are assuming right now with respect to tech and its future. And specifically coming to IT services and SaaS, the fact is AI is certainly here, and there's a lot of possibilities that exist for an enterprise to change their business, the way they do things with AI. But the reality is that a lot of work needs to be done by everyone to make that vision pay off. Obviously, we have heard all of these numbers of hundreds of billions of dollars being invested by large tech into enabling capabilities which drive some of that transformation or enable that transformation. But a lot of it would actually fuel in two different directions. One is it'll actually support a lot of consumer side of the demand, which people like you and I consume on a day-to-day basis for making our lives more productive. And some of it, at least right now, is starting to flow into the business-related transformations. At some point, that's going to flip. As in all of these hundreds of billions of dollars of investments that have been made, they will start making real impact on the business processes, but we are still away from it. And for that to happen, companies such as IT services firms or anyone who's in the business of providing some sort of tech will need to first leverage that investment to power what they do, whether they are building products, whether they're building SaaS capabilities, whether they're building or delivering IT services. And IT services themselves, since that happens to be the key interest in the audience, typically in India, they are using it in like three different ways. They are changing the way they run internally, like every business on earth. Every enterprise is changing the way they do things, but they're also changing the way they serve their clients. And that's where we're seeing a lot of investments being made by the large tech firms or tech services, IT services firm into platforms that enable different services. And finally, they are also trying to identify a place for themselves in this entire value chain. And that's something we need to, that value chain of sort of the demand that the clients essentially have. So we have to figure out where exactly we go from there. So anyway, back to you.
So Ashutosh, I mean, the biggest concern here, and I'm asking a narrower, sharper question now because many of the viewers of this conversation are actually looking to invest in Indian IT companies or have had interests and investments already in Indian IT companies, and they're wondering that whether the model itself is going to change. So if AI is going to come and do a lot of the work, whether it's writing code, whether it's just doing things more efficiently, then will the companies, Indian IT service companies, whether they will now be operating at lower margins? I don't think anyone's saying that they'll go away or they'll shut shop. But the question is, will the increase in productivity, the requirement of lesser employees, will that mean a lesser role for Indian IT companies? And will that work come at lower margins now? Your thoughts?
See, margins are obviously not going to be as high as we have seen back in the day. Will they settle down to an even lower number than today is something I'm not really an expert at predicting, but what I'm going to say, the model is going to change in various ways. Obviously, if we are talking about fewer number of people, we are going to settle at a new normal where you can have more work done by the fewer people. Now that essentially in a way is margin accretive in terms of the very nature of the fact that you are requiring fewer people to do things, but that margin is going to be split between what their clients will seek from them in terms of benefits and what companies will keep for themselves. But then even then, what these companies will need to do is to constantly invest in newer ways, newer technologies, newer innovations, which to sort of drive how they deliver businesses. So you can imagine a lot of investment, at least in the near future, into the AI related capabilities. So I would, if I were a equity person, I would imagine at least in the short to medium term, which I mean, say 2 to 3 years, we will see some impact on margins thanks to the investments that they need to make and the fact that they can't shake off the number of people that they currently have. But at the same time, there's a lot of work that enterprises need today or are doing today, which require people because not everything has got or is likely to get automated away. So you can imagine there's a lot of demand for people. So, but the demand from the clients is already starting to have better year-on-year productivity,
Sure.
better sort of margin sharing. So
Sure.
yes, so there will
Sure.
be some impact in the short term.
Okay, Ashutosh, the market has just opened, so allow us a couple of minutes to look at the rates. And it's a cautious start, actually, 90 points lower for the Nifty. So a lot of yesterday's excitement is getting challenged now, but this is the question. You heard our technical experts say that as long as the Nifty remains above 25,500, long trades can still be taken. But if it breaches that mark, then there would be a problem. But right now, we're just giving off some of the gains that were made yesterday. And what we have is about an 80-point downtick. So 25,600 is where the fight is. Let's go down to stocks and see what's weak this morning. Some of the metal names have started off on a weak note. Hindalco, Eternal, Shriram Finance, these are some of the early Nifty losers. Reliance is also weak. So yeah, we've got the losers up on your screen there. You can see declines between 1% to 1.5%, 2%. This is how it's opening up. Reliance is down 1% as we speak. Trent is slightly lower. JSW Steel is down about 0.7% as well. So these are some of the names on the way down. Actually, today, banks are not providing the kind of leadership they provided over the last couple of sessions, including yesterday. ICICI Bank is also succumbing to some profit taking, for instance. So that's pretty much where the red is coming in from. On the green side, actually, it's more IT. It is all about IT because I think a lot of investors are now looking for bargains. There are the active tactical traders are probably looking for quick short-term trades. But IT is continuing its bounce back. Infosys, HCL Tech up about 1%, TCS up about 0.7%, and Tech Mahindra is up about 0.5% right now. Asian Paints is the Nifty winner, by the way, this morning with a gain of about 1.5%. So that's how it's coming.
Are we done?
I want to come to some of the stocks in focus. And I request Ashutosh to just stay on because we need a final word with him on IT and really what this AI disruption means. But let me talk about some of the other stocks in focus today. Watch out for Cochin Shipyard, this naval order, 5,000 odd crores of the naval order. That's working very well for Cochin Shipyard. 6% up on that stock. No, let's put the stock plate up on the screen. Let's get the stock price. That's what we need to focus on. Cochin Shipyard, which is up 6% right now. We need to then also talk about Texmaco Rail. Let's get that stock up on the screen. 6.5% up on Texmaco Rail. Again, it's a small order that they've got. Cochin is the one that's getting a naval order worth about 5,000 crores. And TVS Supply Chain is the other interesting stock. TVS Supply Chain has announced its intention of getting into an alliance with an Italian company for aerospace and defense. And these are hot sectors. The market likes the sound of it. And the stock is up about 4%. So these are some of the stocks in focus. By the way, I just want to point out that yesterday's slide on capital market stocks, that has not entirely gone away. There's still some red on Grow, on Angel One, on BSE itself. BSE is down about 1%, on IIFL Capital. So watch out for the capital market stocks. They're still dealing with a little bit of pressure, a little bit of pain, as you can see on your screens out there. So we'll keep flashing stocks. Let's keep flashing some of the mid-cap gainers and losers as well. I only picked out some of the important stocks that are in focus, that are in news this morning, and we'll keep rotating this with the other mid-cap gainers and losers. But Ashutosh, just to complete the point, so from an investment perspective, what would you tell Indian investors out there, those who are looking at the Indian IT landscape? What are the key triggers they should be aware of? What are the key milestones they should watch out for? as everybody is trying to, wrap their heads around this question, whether there is still a fundamental reason to be a buyer of Indian IT stocks, Indian IT services companies?
So, Ruby, I'm more of a fundamental type of guy. I really am not good at technical analysis of stocks and the market. So, my sole submission would be that when it comes to tech, there's a lot of tech that still needs to be built out. And as we are seeing, the value of AI that's being built out is going to be realized at the point where it actually impacts the business process, and not just how it gets reimagined, but how it gets executed with AI in it. And that execution layer will have a lot of role to play. Especially IT services providers will have a lot of role to play, and that's where I would imagine that the story is not done yet in terms of, obviously, the margins may change, the revenue profile may change for some of the providers, some of the winners, some of the losers might be there. But overall, I would imagine, if I were to look just purely from fundamental perspective, look at the organizations which are really investing in transforming the way they are delivering their services to the client. If you see some of the stocks or some of the firms which are not investing as much and not talking about AI, still sort of sticking to older way of delivering services, that's where the risks are going to be lying. But the ones which are transforming themselves in all possible manners are going to be the winners in this case. So that's where I'm going to probably distinguish between winners and losers. I cannot really tell you as to what sort of milestones you should be watching out for, I guess.
Okay, fair enough. So, Ashutosh, final thoughts. Today, we'll be hearing from the Infosys top management at their investor day. So, when you're talking about these large companies, and all of them are trying to pivot, right? TCS, Infosys, all of them are trying to pivot and remain relevant in this new AI world. What is it that you'd like to hear from some of the large Indian IT giants?
Right. So, we heard from TCS when they announced the AI revenue some time ago, and they also sort of pivoted into getting at least capturing some of the value that's there at the bottom of the entire value chain in terms of the infrastructure. What I would like to see from Infosys is to, obviously, I don't expect them to be making asset heavy sort of investments in infrastructure and data center. But they are one of those companies which have built products which are actually probably one of the most, I would say, successful series of products in their edge portfolio of offerings, as well as some of the other investments that they're making in the AI-enabled products such as Topaz and others. So I would be interested in knowing how exactly are they carrying forward with the transformation, that momentum, especially how they're changing the way they are delivering products. If you look at banking, for example, Finacle has to undergo a lot of transformation with AI. Likewise, other edge series of products also need to go through. So for a company like Infosys, the pivot has to be moving away from purely services sort of led model to AI platform sort of model. And what sort of move they are making in that direction is something I'll be keen to know from them.
Mm-hmm. Okay, well, we hope to hear more from them. Infosys speaks today, so let's see if they answer some of these burning questions that investors and stakeholders in the entire IT ecosystem really have for the flag bearers of Indian IT services. Thank you very much, Ashutosh. Good conversation and really helpful context for our viewers as well. We hope to keep connecting in the future. Thank you so much. Have a good day. Thank you. All right, that's a view from Forrester on IT and the challenges ahead and the opportunities ahead for Indian players. But now let's get back our full attention to the market. And the market continues to chug along, slightly weaker this morning. By the way, the mid-cap index is falling less than the large-cap indices. Nifty is down almost 0.4%. Bank Nifty is leading that decline today. Bank Nifty is down a full 0.5%. Mid-caps are relatively better off. So we'll keep, of course, putting up the data points for you. But now it's time to welcome in a voice who looks at all the micro numbers in the earnings and specific stocks very, very minutely. We have with us Gautam Duggar, Head of Research at Motilal Oswal, joining in. Gautam, what a pleasure to have you with us on this show. And I'm so glad we're able to connect on Moneycontrol as well. Digital format, new format, but hopefully more pointed, short questions because people want all the analysis fatafat quickly these days, right? And that's what we're hoping to do here on Moneycontrol. Thank you for joining in. You know, before we start with the Q3 report card, Gautam, let me take your thoughts on this big IT debate. And we've heard a lot of views over the last couple of sessions. Many people are saying it's overdone. Some people are saying it's time to actually be a buyer now because these companies they'll last, they'll remain, they'll overcome. Which side of that IT debate do you stand on?
Thanks, Surbi. Good morning. Thanks for having me here. So we'll look which side of the debate we are on is best reflected in our model portfolios. So we upgraded the sector from underweight to overweight after a fairly long time in November 25. Stocks obviously did well subsequently, but now they've all come off given the new development that keeps happening around AI. We think there is value in this sector at this price. Obviously, we don't know where the bottom is and how many more developments will keep coming and impacting the stock prices in the near term. That's beyond our comprehension at this point of time. We also keep hearing the same noises that you hear. Today, Infosys is having an AI day, so we'll wait to hear what they have to say. But purely from a fundamental and a numbers perspective, we just put out a note on Friday, highlighting what is there in the price. Our analysis suggests that the stock prices are currently implying a 10-year FCF CAGR of about 6.5%. They are trading at a free cash flow yields of 5.8 to 6%. In the past, a lot of disruptions have happened, and the sector has stood tall after the intermittent volatility. I would expect the same this time too, though we don't have the sense of timing as to where it will settle. We are not in the camp which says that IT is dead. We think the sector offers good value. Growth rates have obviously come down, so to that extent, the PE multiples need to recalibrate, and they have done already because most of the stocks, for whatever earnings estimate that we have, and to whatever extent we have certainty in them, I think the PE multiples right now are trading at a decent levels, both from an absolute as well as a relative basis. Having said that, at the cost of reputation, I must highlight that the near-term developments can keep surprising us, and therefore the stock price volatility can continue.
Okay, all right, but that's a clear, take on IT. The fact that you upgraded the sector in November itself, and then that you do see value here at current prices. That's good to know and good context, Gautam, to start off with. Which now brings me to the bigger question. So Q3 is done, and I was briefly going through your note, and it seems that you're fairly pleased with the way earnings have shaped up. Because out of your universe, the bulk of the sectors that you cover, I think, companies have shown double-digit earnings growth. Is that right?
Yeah, so we've seen a 16% earnings growth for our coverage universe and about 7-8% for Nifty, which is in line with our expectations. The interesting thing is small cap has turned around after 5 quarters. We've seen a 29% earnings growth for our small cap coverage of 160 stocks. So small cap has been a highlight. Second, the sales growth stood in double digits after a very long time. So that is also a very heartening thing. So all the actions that the government and RBI have taken in the last 12 months on interest rate, GST rate cuts, and also the income tax rate cuts, a part of that is manifesting in the improved demand in several sectors, and that is also reflecting in the top line growth. So that is one thing. And second, of course, we have not cut estimates much. In fact, at a broader level for our coverage universe, there is a minor earnings upgrade of 0.6 and 0.3%. For Nifty, the estimates are flat. So there has been no earnings cut for Nifty this quarter. So that is giving us confidence that earnings are becoming more and more brighter. And with the headwinds related to trade deals aside, I think market should start focusing back on fundamentals and earnings once again. And that's where the picture is turning slightly more brighter now.
That's quite a number. Gautam, you're saying that small cap stocks in your coverage, these are under your coverage or the model portfolio you're talking about? 25% earnings growth.
157 stocks. But Surbi, this was expected. We were expecting about 34%. We've got 29%. This is on a low base. If you look at it on a 2-year CAGR basis, so that number would be about 7% CAGR. It is because of the very low base that the YOY number is looking slightly higher, and it's well within the expectations. So it's not as if that there's a big surprise out there, but the mere fact that there's no disappointment and there are no big earnings cut out there, and the trajectory has changed, though on a low base, it's slightly better news compared to what we've been used to for the last 6 quarters.
Yeah. Yeah, I can see some of the names now from your note. The mid caps and the small caps that have delivered best earnings in Gautam's universe. There are names like Hitachi Energy, there's BSC, Laurus Labs, Vari, MRF, Kalyan Jewelers. Kalyan, of course, was scintillating, 40% kind of growth. Radico Khetan, there's Delivery, Naveen Fluorine, MTAR, Amber, lots and lots of names there that have really delivered well. So now the question, Gautam, is the mid cap and small cap universe really reviving from an earnings perspective? What would be the general projections of SMID earnings, small and mid cap earnings, that you will now take forward for FY27?
Yeah, sure. So look, mid caps have anyways been doing well on earnings for last 2 years now. In fact, last year, FY25 also, if you look at the mid cap earnings growth, they were 2x of large caps. And that differential in mid cap versus large cap continues. Even this quarter, mid cap have posted 15%, slightly lower than expectations, but on an absolute basis, still fairly good. In fact, if you look at the mid cap X commodities, they've done 20% earnings growth. So on a full year basis, also we're expecting close to 20% earnings growth for mid cap this year, whereas large caps are going to grow at about 11-12%. And that trajectory should, extrapolate to FY27 as well. In fact, in FY27, we have similar expectations for mid cap and small caps. So clearly, earnings are reviving there. That's the expectation. That's the projection. Having said that, the valuations are not cheap there. Mid cap index is trading at 28 times. Small cap index is trading at 24 times. It's the large cap index, the Nifty 50, which is at 20.4 times, and which is at a slightly or maybe a minor discount to its long period average. So valuations are more comfortable in large cap, but the growth, as is always the case, is slightly higher on the mid and small cap side of the equation. Now, of course, mid and small cap, while we discuss index, but no one invests in index in mid and small cap. They're largely bottom up ideas.
No, absolutely. So right now in your model portfolio, Gautam, what is the skew between mid and small, mid, large and small? Because that's the biggest debate, right? So many people on the street are advising investors to remain with large caps. And that's where the confusion is. But as you're rightly pointing out, the growth is coming, bottom-up growth is coming in more in mid and small cap names. So in your model portfolio currently, what's the mix?
So it's 30% or maybe 31% for mid and small cap and 69% roughly for large caps. That's how the mix is. And over the last 6 or 9 months, we've increased the allocation to mid and small cap by close to 500 basis points, predominantly driven by our view on earnings. And then, of course, our bottom-up ideas from the analyst team.
Sure. So I'm looking at some of the top earnings upgrades. I mean, the stocks that you've upgraded because of a good performance in Q3. Titan has got that upgrade from you, Dr. Reddy's, Ultratech, Tata Steel and Nestle. So let's talk a little granular in terms of the best earnings surprises and whether these stocks look promising enough to you for the next couple of quarters as well. Give us any ideas. Name 2-3 names where you really had high flyer earnings, where you think there's still a lot of visibility going into the next few quarters as well.
So clearly, one of the highlights of the earnings seasons was SBI, which is our top idea amongst the top 5 India ideas and has a huge model portfolio allocation, which we had incrementally raised again in January. So that name has posted the best results in the banking sector for some quarters now. Is going to deliver another year of a 15% ROE. The credit growth has stood very solid at about 16%. They have upped the guidance for their loan growth. So all boxes were ticked, and you won't believe, but asset quality at the net NPA level and PCR, they are now mimicking ICICI Bank and are slightly better than HDFC Bank and Axis Bank. Who would have thought that 4-5 years back? But bank is still trading sub 1.5 times. I think it deserves to re-rate more from where it is right now. Plus, the subsidiaries are also generating good incremental value out there. Second, Titan, obviously, it continues to remain our long-standing top idea for more than 15 years now. They've come out with a good set of numbers. So again, that's part of our top 5 India ideas. Then you have auto names, which have done exceedingly well this quarter. I mean, the auto earnings growth ex of Tata Motors was 24%. The data that came in the month of January for the auto monthly volumes was also very strong across all segments. We continue to like M&M and TVS Motors out there. Then we have a very strong preference for some of the other discretionary names like Eternal, Indian Hotels, Radico. And then, if you move towards financial space again, we like some of the capital market themes like Grow, We like some of the AMCs which are there in our model portfolio, and of course NBFCs like Shriram Finance. And then we have a sector-specific approach where we are overweight on IT, as I discussed in the beginning. We find valuations quite okay now, notwithstanding the near-term and intermittent volatility which will keep cropping up. We are positive on Bharti Airtel, right? CapEx, we are taking a slightly neutral view out there. We have presence in CapEx through L&T, Bharat Electronics, and Ultratech. And then we are underweight on consumer staples. In fact, we have zero allocation to consumer staples. We're marginally underweight on private sector banks, though we like bottom of specific names in that sector. And we remain underweight on commodities. So that's how we are positioned in our model portfolio across sectors, along with some of the names that I just mentioned, which are our high conviction top ideas.
You know, I have to ask you a little more on capital markets, Gautam. No surprises here, right? Now, because of one reason or the other, either it's SEBI regulation or it's some new F&O regulation, now it's RBI tightening the screws on bank funding, then there was the STT hit in the budget. Some or the other reason, these stocks managed to get singled out. And I was looking at prices. We should pull these up. Angel is down about 0.5% today. BSE, by the way, BSE is falling again. BSE is down 1.5%. Bombay Stock Exchange. Let's get those stocks up. Billion Brains, which is Grow. Grow is also mildly lower. And most of these stocks, Gautam, are down between 15% to, in Angel's case, Angel is down 22% from the peak. What still makes you optimistic and confident on the capital markets theme, given the multiple regulatory issues that keep cropping up?
So look, we've been positive on this space for more than 2 years now. I think one of the best teams to play in India right now within financials, because large caps on the banking side, especially private sector bank, the growth is moderating a bit. Second, the whole capital market ecosystem is evolving in a major way in India. We have seen the explosion of demat accounts from 4.5 crores in March 20 to now almost approaching 22 crores as we close March 2026. This has resulted in massive opportunities for whole gamut of players to operate in this ecosystem, whether it is brokers, wealth managers, exchanges, asset management companies, depositories, and several other intermediaries. The nature of the business is such that it is cyclical and it is prone to a lot of regulatory actions. The government has been very clear and vocal, both government as well as regulatory authorities, that they want to curb these speculative volumes, which I think augurs well from a fairly long-term perspective. But in the midterm, or maybe in the short term, it will create its own impact in terms of the volumes, in terms of the near-term earnings, and therefore there could be some multiple compression which could happen, and which you have seen happening in the last 1 year. But that doesn't change the outlook for the capital market evolution in India. I mean, the nation is turning from the nation of depositors or savers to nation of investors, and which is where you're seeing the way AUMs have expanded. The equity AUMs, which used to be 2 lakh crores in 2012, I remember that because that's the year I joined Motilal Oswal, to now about 40-41 lakh crores. And we are seeing very consistent, gradual increase in the SIP book. So I think the runway for capital market players is fairly long. And as we move towards 30 or 35 crore demat accounts in the next 5 to 6 years, you will see a good earnings compounding happening in this space, which anyways has been progressing at a fairly good clip in the last 3 years. In fact, for the quarter just ended, the non-lending NBFCs, which is how we categorize these companies, they've posted a growth of 34%, which is slightly better than what we expected for third quarter. So that is what keeps us excited, even though there can be price correction or time correction in the near term.
Gautam, now I want to come to, so we discussed a lot of the upgrades and the stocks that you're really, really convinced on, looking at the earnings trajectory, and you named quite a few of them, including Titan, SBI. Now I'm looking at the top downgrades. And here Eternal really stands out. I think you've cut your earnings estimates by over 14% on Eternal.
So, before you expand on that, it's a low PAT margin business right now, right? So any minor change here or there, 10 basis point of a change will result in a higher magnitude change in the underlying profit numbers, both on upside as well as on downside. Sure. So I won't look at it beyond, I mean, it's more a statistical number right now, rather than, even when the earnings were upgraded a year back, you would have seen 20-30% kind of earnings upgrade or changes happening fairly regularly in these companies in the new age basket, because the profit margins are very low. So therefore, sensitivity to the change in 10 basis point, 5 basis point margin to the absolute PAT is much, much higher here.
Okay, but what's the story on Eternal? Again, one of those stocks which is in a sector that's noisy by nature, Gautam. What did you make out of the profitability trajectory for both Swiggy and Eternal, given that they're very much expanding and they're investing in their quick commerce? Food delivery is stabilized, but quick commerce investments are still going on. That out of home, going out business that they're building, their investments are going on. So what were your key takeaways and what's the advice on this new age space, these two stocks?
Continue to like the quick commerce space. The growth is pretty strong in the quick commerce side. That's where the story has changed in the last 2 years. If you look at the total value that Zomato has from quick commerce business 2 years back and what it is today, it's a massive transformation. We expect the growth to continue, albeit with a lot of changes intermittently in the level of competitive intensity that is prevalent in the sector. That can obviously decide the nature of the short-term earnings and short-term stock price movement. But if you are to take a slightly longer-term view again, because a lot of these companies, they will tend to remain very volatile in the short term. Because someday some company will come, raise the discounts and so on and so forth. And that will have a bearing on the short-term numbers and stock price direction. But be that as it may, the long-term picture remains extremely strong out there. You will see more listings happening in this space. And therefore, the room for wealth creation in quick commerce space from a 3, 5, 10-year perspective, in our view, remains very, very high. And that's why we have Eternal also in our top 5 ideas on the large cap side. It's predominantly present in our model portfolio. And we also have a buy rating on Swiggy.
Okay. So buy on Swiggy and Eternal remains a top idea for you. But I guess it's like you're saying, it's going to be longer term wealth creation with periods of volatility. So investors need to kind of account for that. Depends on each one's risk appetite and time horizon. Gautam, we've had a great micro conversation. Now I want to pull out to the macros before we let you go today. The thing is, and I'm going to go back to that Nifty earnings number, because as far as your universe is concerned, you go down to tier 2, tier 3, small cap earnings, mid cap earnings, things are looking good. But that Nifty number, which is stuck in single digits, and I'll tell you why I'm asking that, because when foreigners are looking at the India market, I guess they will look at that big headline number, right? Okay, what's the benchmark index delivering here in this market in terms of earnings? So if they're getting some 30-40% in Korea and these other markets, and the Indian market benchmark is still giving you 8-9% earnings growth, then that's a problem, isn't it? So where is that number going in FY27? And even if that Nifty earnings number goes to say 11-12%, is it going to be enough for the foreigners?
Look, so it's very difficult to decide what's enough for and what's not enough for foreigners. What we can do is we can do our analysis and our numbers projection. We'll come to what foreigners may or may not do in a bit. So what we are saying is this year we are ending the year at 8% earnings growth in FY26. Our projection for FY27, which is not changed between the preview and review, it still stays at 16% earnings growth next year, and then about 14% for FY28. So we are talking about a 15% earnings CAGR. The period between FY20 to FY24 was slightly, I won't call abnormal, but a bit of an outlier, because we had a 4 consecutive years on earnings CAGR of more than 20% for Nifty and 25% from broader markets. Then FY25-26, we have seen about 5 to 6% earnings CAGR for broad headline indices. What has happened is 3 big sectors in Nifty, which is consumption, private banks, and IT. The BFSI IT plus consumer, this segment accounts for 60% of the total profit pool. And these 3 sectors had a mid to high single digit growth for last 2 years. And that is where the drag on the indices like Nifty is coming from. If you look at the broader market indices, in fact, for this quarter also, Nifty's earnings are up 7%. Our coverage universe earnings are up 16%. Right? This year, Nifty will do 8% earnings growth. The Motilal Oswal coverage universe of 340 plus stocks will do earnings growth of 14%. That's because the relevance of these 3 big sectors in Nifty is disproportionately high, and all of them had a single-digit earnings growth. Whereas in the broader markets, broader indices, or our coverage universe, the contribution of these 3 sectors is relatively lesser, whereas the other cyclicals like PSU banks, which are doing well, capital goods, which are doing well, several others like metals and oil and gas, their contribution is slightly higher, which is why you're seeing this mismatch in the growth between the broader markets and the benchmark indices. Now, coming to foreigners, I think one of the reasons, there's again, I mean, there can be many reasons. One of the reasons they stayed away, obviously, the slowdown in earnings growth coupled with expensive valuations. So, valuations is something which is now turning a bit more favorable, right? I'm not saying this is cheap, but it's a bit more favorable from where it was in September 24 when the markets peaked. We are down from 22, 23 PE multiples on Nifty to about 20.5 times. Incrementally, the growth is improving. The other macro concerns on trade deal and all are behind. The government and RBI are seized to the growth and they've taken several measures. The budget has broadly maintained the path of fiscal consolidation. So a lot of things are clearing up. It's very difficult to pinpoint at what particular point the foreign flows will turn. But I would expect that as India becomes incrementally more attractive on the earnings versus valuation metrics, those flows will also follow suit.
So 15% earnings growth compounded over the next 2 years, right? With better macros and some of the other concerns out of the way. Okay, that's a good headline to go with. And after years of single-digit earnings, I think 15% really sounds good to the ears. Gautam, fantastic conversation, very in-depth and very exhaustive. Thank you so much. Really, explains to us where we stand at the end of Q3. Thank you so much. You have a great day, and we look forward to connecting again soon. Thank you. All right. Well, that's an exhaustive earnings summary at the end of Q3. By the way, before we get to our next conversation, the market has tried to recover already. The mid-cap index has already bounced in positive territory, and the losses have been reduced on the Nifty, as you can see over there. Nifty has also recovered quite nicely from the lows of the day. The Bank Nifty is still sulking. The Bank Nifty is still down about 0.5%, and that's where the pressure is coming in from. But it's early in the morning, and let's see if the bulls manage to prevail. But this is very similar to what happened yesterday. We opened a little soft, but then the second half, the market really picked up. So let's see if that same template plays out today or not. Our next conversation is on real estate, and you really don't want to miss this one because it's going to be on residential real estate and what is happening in different pockets. Is there a slowdown building in residential real estate? That's the big question. And we will be back in just a moment with our next guest from Knight Frank. In the meantime, check out some of these key brokerage highlights of the day. Back with that conversation with Knight Frank in the next few minutes. Welcome back. Well, as promised, we've had a long conversation on equities, but now it's time to talk real estate. Knight Frank came out with its usual report, the half-year summary, and this time obviously it also comes with the full 2025 summary. And the trends in residential real estate are looking very, very interesting. It seems that there has been lesser supply in the affordable housing segment. The middle market segment seems to be going along, quite well. But there seems to be a lot of inventory build up in the very premium end of the market, in houses that are, more than, say, 10 crores or 50 crores. So what is all of this really telling us, and how is the residential real estate market poised as we look at 2026? Well, to answer those questions, we have with us Ghulam Zia from Knight Frank. Ghulam, what a pleasure it is to welcome you on this conversation on Moneycontrol. You're with us on Opening Bell. We've discussed real estate and trends and rentals and rental yields for years on CNBC, but I'm glad we can connect on Moneycontrol as well. Welcome to the show.
Thank you so much. It's always a pleasure to talk to you. It's been a different level of interaction, and I'm expecting the same to continue today as well.
Thank you. Thank you so much, Ghulam. So, your note really caught my eye. So let's break it down, because there's so many different levels to it, right? So I want to start by breaking it down for our viewers in terms of just what's happening in overall sales. Because when I looked at the full year number, and we'll put the numbers up on the screen, total residential housing units sold in 2025, that full year number is flat over the previous year. In fact, I think it's down by just about 1%. So is the residential real estate market plateauing?
Well, that's the point. We also believe, because there have been a lot of other narratives throughout 2025 and now also last month or two. People continue to talk about a decline. What we are trying to bring out with these numbers is that the decline is not yet around the corner. Because if the numbers are still talking about almost the same trend as the previous year, 2024, 2025 saw almost the same thing, and as you say, just about 1% of a decline is hardly any decline. So yes, the question arises, have we reached that place, that position from where the decline may begin? But again, something which the data does not talk about. So data is still saying, as you rightly said, Surabhi, that we are reaching that place from where things may look flattening out. Well, within those sales numbers that we're talking about, different segments may behave differently. Few segments may have good momentum going on, and a few segments would be slowing down faster than the rest. But overall, if you're looking at the numbers of the top 8 cities, the market is appearing to be flattening out, Surabhi.
Yeah. And I just want to stay on this graphic that we have on the screen right now, because our team has nicely color-coded it as well to make it simple for viewers. And it's very clear that in the second half, so let's now look at the second half and see what the trends are, telling us. So in the second half, Pune and NCR have seen a decline in sales. NCR in particular, down about 10%. But some of the other markets, especially down south, they are still seeing very healthy growth in sales. Look at Hyderabad, 13% up. Look at Chennai, 7% higher. So what do you make of this decline, especially in Delhi and surrounding areas, NCR? What's going on in this market, Ghulam?
Well, Surabhi, we have seen it in the previous cycles as well, that NCR is a market which typically behaves very, very dynamic. Numbers are coming up from that market. Like when the fall is there, the fall is very, very clear. But when the rise comes, it's, kind of numbers that you don't believe. So if you look at, say, for example, Gurgaon market in last year, 2025, we saw some crazy number of sales happening in the upper end of the market. And then it extended to even Noida, Greater Noida, where high-end the luxury sales, etc., actually shot up. So the point remains that whenever NCR as a market is looked into, this market actually behaves very, very, either very high or very low. So it's a very choppy market all through. For last 20 years, we've been watching. Other markets, you see the ups and downs gradually sinking in. But here you see sudden changes very, very often. So NCR is a different market. Now, the other market you are also highlighting is Pune. Pune has been performing very steadily for last almost about 6 to 7 half yearlies. But last half yearly was the first time we started looking at some negative sales numbers. But apart from that, as I was saying a short while back, the numbers we're talking on the top 8 cities are looking almost flattening, but a few cities are behaving differently, and NCR, Pune are the two of them, as you have rightly picked up.
Okay, so that's the overall pan India picture and what's happening in top 8 cities. By the way, Mumbai, lots of our viewers are from the city. Mumbaikars, please note that in Mumbai, real estate sales are still happening, but the growth was only 3% in the second half of the year. That's all 6 months, July to December put together. So now let's talk about within segments, what kind of stock is flying and what's not flying in terms of just the price points. And again, this is an all India picture that we're taking. Let's move to the next plate. Now here it's very clear that there is a decline in the affordable segment. Houses up to 50 lakhs, up to 1 crore, down 7%, down 3% respectively. The 1 to 2 crore category seems to still be kind of finding some takers. So we have the unsold inventory picture as well over there. That's very, very clear. So unsold inventory has declined in the affordable housing segment, because Ghulam has been telling us this, that we're not getting too many launches in affordable housing. But you can see the inventory build up in 1 to 2 crores. Huge amount of inventory build up in the 2 to 5 crores bracket, and going further down 10 to 20 crores, 20 to 50 crores, above 50 crores, massive inventory pile up. This usually is not a very comforting sign from an investor perspective, Ghulam.
Well, looking at just the inventory is not a complete picture. It's not giving you the full picture. The next column that you also have on your screen right now is how many quarters would be required to sell that inventory. That is the key to look at. And that's basis that developers actually launch their projects in the market. So if you look at those numbers, what it talks about is how many quarters required to sell that segment of inventory. And when I'm looking at that, except for one segment, last time also we spoke, I was trying to highlight to you that the 20 to 50 crore market is absolutely going through a serious trouble. Because that's where you see almost 4 years of inventory piling up. When I say 15.8, almost about 16 quarters, this is about 4 odd years. 4 odd years of inventory pile up in that segment. But rest of them all are in single digits, which means that about 2 odd years you will sell your inventory, provided there is no more inventory kicking in, no more inventory launches, etc. happening. But then assuming we are in a market where the trends are gradual, then I would be seriously worried about 20 to 50 crore market where the inventory pileup is crazy. Rest of the markets are not that bad. When you're looking at the growth in 20%, 14%, 40 odd percent in 2 to 5 crore, but then the market is supporting because you're going to take not even a year to absorb all that market. So just looking at the numbers, how many new launches are happening is not good enough, or how many apartments out there to sell is not good enough. You have to look at what is the velocity of sales, and that velocity of sales is appearing very clearly in the last quarter. How long will it take to absorb that inventory?
Fair enough. And that's why I appreciate your concern that the 20 to 50 crore segment, there it's almost 16 quarters would be required to sell the current amount of inventory in the market. So that seems to be a bit of a vulnerable spot. In the others, 2 to 5 crores, 5 to 10 crores, it's still about 3 to 4 quarters worth of inventory, which I think is seen as normal in the sector. Ghulam, what's happening to pricing? Now that sales are flattening out at a full year level and a half year level, are there markets that are beginning to show a pricing crack? And when I say pricing crack, that could also mean more freebies loaded up and free parking, etc., etc. There's a different way in which you play with pricing, right?
True, that's very true, and that's something which is typically given to you under the garbs of festive sales, etc. But right now we have crossed all that period of festivity. So where we are entering and where we are standing, these offers coming in are very clearly showing signs of desperation, and which is building up in a few markets very hugely. Again, starting with NCR, that's one market where the prices are already under severe pressure, because in the last 2 odd years, the prices have almost doubled up in most of the categories. And that is something which is worrying the buyers, because the moment affordability goes out of the window, your sales numbers start shrinking, and the developers are then worried because your velocity of sales slowing down, amount of time required to consume all the inventory you have on your showroom is something which is also a big worry. So here the prices have almost remained flat, barring a few markets. Like, something which I was very surprised about is that Hyderabad continues to show the price rise. Even Bengaluru price rise is continuing. And that is happening because the developers are yet very comfortable with the inventory and the way they're selling.
Sure. So Bangalore and Hyderabad prices are still rising. What's happening in Mumbai and what's happening in NCR?
Well, I started with NCR, that in NCR is severely under tremendous pressure to correct the prices, and which is visible because most of the developers are offering those the benefits or the all the sales jargons are going on in those markets. But in Mumbai also, in at least that 20 to 50 crore market which I highlighted for almost about a year, the offers are piling up. Whether it is stamp duty correction or developers taking the whole stamp duty or giving furnishings or stuff like that. A lot of those things are happening in that specific segment. But the upper end, again, Mumbai is behaving very differently. The moment you go above 20 crore market, in fact, there is a huge dearth, because the velocity of sales, as you saw, barely a year required to sell whatever velocities in the market. So different segments are behaving differently, but overall, the pressure on the price is now visible because we have breached that level of affordability. Even in Mumbai, at least we are looking at pressure, the prices remaining flat. And as I said, barring one or two examples, most of the prices are remaining flat.
So flat, but the pressure is visible only in the 20 crores and above bracket in Mumbai, which is where there's higher inventory. The other segments are more or less flat in Mumbai, right?
Correct. That's true. The 20 to 50 crore, as I said, 50 plus. In Mumbai, we have a sizable chunk of 50 crore plus kind of inventory. That is where there is no pressure. In fact, the velocities are fairly good. And hence, that segment is something where there is no sign to worry. And that's where the prices are going up. So if you look at an apartment which was selling for 150,000 a year back and selling at 2 lakh per square feet now, it shows the trend.
I can't even comprehend, Gulam, these numbers and this beyond 50 crore inventory. I can't comprehend. I'll leave that to you. But okay, so final sense, I mean, given all of these trends, we've spoken about inventory levels, we've spoken about pricing. What's the bigger picture? This upcycle in real estate started in 21, 22 maybe, just as we were getting out of COVID. So they say, wise men like you and others say that typically real estate cycles last for 10 years. I don't know if that's true anymore, whether cycles are longer or shorter. But whatever that cycle duration is, where are we in the realty market, in the realty cycle now?
See, overall, when we are talking about numbers, and you and I have discussed that many times, that typically 10 years is the property cycle, and we are on the fifth odd year of the upcycle. So perhaps we have reached that position. We started our whole conversation today that are we flattening out? Are we reaching that place from where the prices may or the overall market may look down upon or start correcting? Well, possibly, yes. We feel that we have reached that place where things are flattening out. However, it's important to say that different cities also behave differently. Like those cycles may not be alongside in all those cities coming together. The overall market may look shrinking, but then again, today most of the developers have gone to different markets, and the reason is simple that if one market is not doing well, the other market would behave differently. So that's the reason developers are also smartly spreading, and especially the listed players are spreading into all those 7-8 cities. And that's the reason why they are actually taking the benefits of different cycles in different markets. So a few, like for NCR for sure, it seems like we have reached that top position. Maybe 12 o'clock to 1 o'clock position is already upon us. The other markets, we are either about 12 o'clock or reaching 12 o'clock. So different markets, we have to watch closely next few quarters. And next time when we talk, maybe a year from here, we would see a lot of other cities also reaching that bracket where NCR belongs right now.
Okay, so maybe a sign of caution is warranted as investors look at residential real estate. Perhaps it'll serve them well to look at some of these nuances and look at these trends before they decide their actions ahead. Well, I'm very helpful as always. A very comprehensive report that your team brings out, and it gives us so many important takeaways and clues into understanding what's happening in the market. Great conversation. You have a fantastic day, and we look forward to remaining in touch. Thank you.
Thank you.
All right. Well, there you go. So from equities to real estate, we have you fully covered. Let's do a quick check on the market. And then we are going to leave you with some takeaways from the big AI event that's underway in New Delhi. The market for the time being is quiet. There's not much happening. We're at the flat line, 20 odd points down on the Nifty at this juncture. The mid-cap index is also completely flat. The good news is that the Bank Nifty has cut its losses. The Bank Nifty was down almost 0.5%. Now it's down about 0.25%. So those are some of the trends to keep in mind. Infosys is really moving higher. And we need to see what are the clear takeaways from this investor day that's going to come up at 11 o'clock. Infosys is up about 3% as we speak. HCL Tech, Wipro, Tech Mahindra, actually all of IT. It's a great day for IT. TCS, all of these stocks are up and about. So that's one clear trend that stands out, at least for the time being. Eternal, the stock that we were discussing with Gautam Duggar just a while back, Eternal is really weak, down about 3%. He gave his view that long term he's still optimistic, but yes, short term, there has been a bit of a cut in earnings estimates. There is a Hindalco and Tata Steel, two stocks which are down from the metals pack. And watch for some of the heavyweights, Reliance and ICICI Bank. These are the ones that are putting a lot of downside pressure today on the Nifty, at least as far as the morning is concerned. Reliance is down almost 1%, and ditto for ICICI Bank as well. There you see it's down about 1%, and Reliance is down about 1% as well. Okay, so that's what we have. Let's see if we can actually get to any of the clear takeaways that we had from the AI Summit. Can we pull up something from the AI Summit as we wind down? Yeah, okay. So let's hear out some of the important newsmakers, some of the important sound bites that came in from day one of the AI Summit. This, of course, is from yesterday. Today's events will be, unveiled later as we continue through the course of the day. But here are some of the important newsmakers from that AI Summit on day one, which was Monday.
Hello viewers, here I am at Bharat Mandapam where India AI Impact Summit is being held. It is one of the largest AI summits globally that has ever been held. There are delegates of over 100 countries, thousands of delegates that are going to participate in the summit. The summit will be held over next 5 days. There will be innovators, policy leaders, thinkers who will be participating in the summit and discussing how AI is and can impact various sectors of our economy, whether it's agriculture, whether it's health, whether it's the economic growth and inclusive growth that the AI looks at boosting, how AI can be used to boost that. How important is the summit for AI?
The summit, I think, is very important to locate India firmly on the AI map as a leading country which looks at the technologies related to this and also looks at various other aspects which are important there.
But in policy making, how do you see the usage of AI for the government?
For the government, there are a number of areas where I think it can be a huge force multiplier. We have issues regarding how technology itself can work in a number of situations to ensure that in places where we are unable to provide adequate human resources, it is nobody's case that governments are adequately staffed, whether you're looking at the number of doctors, nurses, teachers, policemen, judges, and in all of these key areas. So in that sense, what we are able to do with AI as a force multiplier would be very, very important.
But how do you see the impact on jobs? That is the big question that everybody is asking.
I believe that in the Indian context, the implications on jobs is not as adverse as many people fear. For all the jobs which may go in certain directions or certain aspects of AI, you would actually see many, many more jobs being created.
Hello and welcome to Moneycontrol, sir. Now this big AI Impact Summit that India is organizing, and now we are seeing AI impacting all our sectors basically. How do you see in policy making the role of AI?
I think artificial intelligence is going to be very important as far as policy is concerned. The way policy is going to be drafted is going to be, in a way, instrumental about how artificial intelligence will play out within the country. So right now, we do not have an AI law per se in the country. The policy of our nation at this point of time is soft touch regulations. And while we have soft touch regulations, we are mindful that hard laws such as the EU AI Act can go against innovation and probably stifle also the availability of data for our young entrepreneurs. Given this situation, policy is going to be very crucial. in terms of drafting the scope and the landscape of artificial intelligence, the good that is to happen through artificial intelligence, and more so ensure inclusivity for those who haves and the have-nots.
But do you think the policymakers especially should tread with caution and go a little slow on AI because a lot of risks have still not unfolded before us?
I agree that artificial intelligence is still an uncharted territory. We are still learning a lot about it. And that is why even the Parliamentary Standing Committee on Communications and Information Technology is mindful of it. The ministry is mindful of it. Lawmakers are mindful of it, and we do not want to rush into making some very strong laws per se without having tested the canvas of artificial intelligence. So it is with caution, but with remarkable caution also comes positivity.
How do you see the impact of AI in jobs? Because jobs is a very, very politically sensitive area for India.
You see, when computerization happened, people said that computers will take away jobs. It led to reskilling. Artificial intelligence will happen similarly. You'll find that reskilling will happen. People will be able to use jobs to leverage themselves as AI-enabled jobs rather than AI-less jobs. Just like you used to have IT-enabled jobs versus IT-less jobs. So therefore, the problems about jobs is not about in terms of unemployment, but in terms of upskilling, reskilling, and relearning.
We will be bringing you insights and conversations from the summit. So stay tuned and watch this space for more.
All right, so that was day one, and today is the big day, day two. Expect more announcements, by the way. And one of those announcements has already come through that there's going to be a partnership of sorts between Anthropic and Infosys. Look at that stock up about 3% as it's leading the IT rebound. Overall IT stocks recovering very smartly. We're at about 10 minutes past 10 o'clock this morning. In the next 50 minutes, Infosys will be kicking off its Investor Day. Make sure you come back to Moneycontrol because the entire Investor Day is going to be live streamed right here on our YouTube page. So please keep it with us. We'll come back and of course you can hear it from Mr. Nandan Nilekani himself, Mr. Salil Parekh, on how AI will play out for Indian IT services now and whether it is indeed different this time or not. So that's the Investor Day, 11 o'clock. Live streamed on Moneycontrol. So make sure you tune right back in the next 50 minutes. Enough time to go grab your breakfast and we'll see you again at 11 o'clock. Thank you so much for watching. It's a wrap on Opening Bell.